Welcome back to Saving to Live. My name is Shay, and today's Ali Invest video is going to talk about cash secured puts. So, first things first, when you are doing a cash secured put, you only really are doing this for two reasons. One reason is you was on YouTube like I was when I first found out about cash secured puts, and everyone talked about how you make so much money doing cash secured puts, and it's the easiest and the most basic way to continuously get paid to make these bets on the strike price not being hit, and you get to keep these premiums that can range from a little bit of money to a whole lot. The second way and the second purpose for these options is for people who actually want to own the stock long term but don't want to actually buy at that present price. With this option, you are able to reap the benefit of also receiving a premium, which can help you lower the cost of the overall purchase of that stock. Now, options aside, if you are a person that just don't even want to mess and fool around with options and you just want to really just do a transaction that's similar where you want a stock like Fisker, but you don't want to pay 22.57, you want to pay like $18 because you feel like it's going to go down, then you can just do a simple stock trade of a limit order where you will go to the stock and then you will go here to order type and do a limit order. This would give you the same kind of benefit of, hey, you're telling the market, I want to purchase this stock at a lower price, and they take the collateral for it, and when it hits, it hits, and if it doesn't, you just get the money back and you go that way. The thing about a limit versus an option is, of course, you get a premium. You get paid right then and there from the option side for making that transaction versus on the limit side, you're not getting no money for making that transaction of wanting to purchase Fisker at a lower rate. I'm in my account right now. I like to go to the research section and go to options because this gives me not only the option chain, but it gives me the workbench, probability calculator, and the profit and loss graph. Everything you can need to make the best decision to make your option contract right here in front of you. Okay, so the first thing you want to do is you want to choose an expiration date. Now, when it comes to doing these type of trades, many people give you, for the people who actually want to own the stock, they go through 30 to 60 days most times. But if you're a person who just want to capitalize on the different premiums and just get that money and keep on doing it over and over and over again, my strategy, which everybody has their own strategy, is to try to pick a date that is not so far out because time is your enemy. So for me, I would say, well, I want to choose the 17th and the 25th. With this side, you are able to choose two different dates and it gives you options based upon both of those dates as you see here. So as you can see, the closer in date time, I guess like under 30 days, the premium isn't all that. Now, if I was to come back out here and go to April the 30th, watch what the premium is going to be. It's like $2 and $3. It's because the dates is further out. So let's keep that in mind when you are doing your date selection. So because I really don't want to wait all this extra time, I'm okay with getting $1.36 or $1 for each contract I do for this put. And even though it says $1, it just means $100 that you're going to receive as your premium for the bid. Now, I'm going to focus on 17 days, April 1st. Right now, Fisker is at 22.57. I'm going to say, well, I want to put my bid at 19.50, which means basically I'm going to do a cash secured put at 19.50 strike price. I don't feel like Fisker is going to go to 19.50. So I feel promising that this $84.84 you see right here is going to be in my pocket and I'll be able to spend that after 17 days or maybe even before, because you do have the option once you make this transaction to get out of this contract if it's going in your favor. So I'm going to do that. I'm going to come on down to my next section, which is going to be the workbench. And you see right here, it says cash secured put. But you just got to remember, this is per 100 shares when you're doing these options. So now we're going to go to the probability calculator. This calculator is used implied volatility to help us determine the probability of hitting our targets before we even place the trade. So this is good for your option or a stock investor. So what you want to do, as it says right here, is set your target date, volatility, and price targets. So the target date is going to be April the 9th, and then volatility, I'm going to choose April the 9th as well. And then the price targets, the lowest I want to go is the actual amount of my strike price. So I'm going to say, what is that again? 23. And the highest is, I want to say, okay, it's currently at 25. I'm going to just go to 28 just to see. And then you click this blue button here, and it tells us that touching the low target, which is 23, is about 83%. That's very high. Touching the high target is 78%. Finishing below the low target is 49%, less than half. So that's okay. And then finish between the targets is 19. And you have the other one here at 31.45%. Now, depending upon how you feel about these numbers, you would definitely change based upon what you feel like is going to be a good or bad option trade. So then you're going to come down to the profit and loss graph. Now, the profit and loss graph is pretty much, it makes it easy to get a thorough understanding of the profit and loss potential before we actually place the trade and see how outcomes may change based on changes in volatility in time. So this is another one that I really do like, which is why I like to come to this section to actually do the profit and loss. So again, we're going to change the date to April the 9th. And then it pretty much gives you the graph here. All right. And so when you come straight down here, you go back into the workbench. You already have everything here. And then once you click on the trade option, it comes over here in the quick trade because that always populates. Now, it goes to bid, the natural, mid, and ax. I always, me personally, try to do the mid and the bid price. So that's will be how you would actually do your cash secured put. Now, for the sake of just giving you the information, let's say you did the cash secured put and then 3 days later it was in your favor where you got some money and you were like, you know what, I want to cash this out while it's going in my favor because I don't really know what's going to transpire. They say you should not allow your options to go to expiration. I have never let mine go to expiration. So what you would do is you will come back inside of this section here, and because it says sell to open, you would do a buy to close. This way it will close your position, and just know that the further down the price of the stock goes, the higher these will tend to be. So just make sure you're doing it in the way where you are receiving a profit versus shelling out more money inside of your account. I typically, when I receive a premium, keep it inside of my actual account until I am done with that option contract, because I may want to get out of there sooner or later, which may limit my premium, but I still receive some sort of money back versus digging into my actual checking or savings account to pay the money to close this out. Totally up to you though. So it all boils down to you want the stock price to fall slightly below the strike price and stay there until expiration. That way the buyer of your put will exercise it and you will be assigned and you will be obligated to buy the stock. Good news though, the premium you receive from selling the put can be applied to the cost of the shares, ultimately lowering the cost basis of the stock purchase. Now, there are 4 scenarios of this put option once you actually place it. The first one is the stock falls below the strike price. The put will be assigned and you will buy 100 shares at the price it fell to. Now, for us, it will be $23. Now, don't forget, you kept your premium in your account like I did, or you may have spent it, but you still received that money in advance. Then you could subtract that from the share price and do a happy dance because you save more money per share price out of pocket. Now, the second option is, now imagine the stock price rises and stays there until expiration. Now that's bad news because you were wrong about the movement of the stock. Since it didn't come down to the strike price, the put won't be assigned and you won't get the stock. And you missed out on the potential gain that you could have had made if you would have just purchased it outright. But you still get to keep the premium and spend it how you like. The third option is the stock falls past the strike price. Now, the put will be assigned to you and you'll pay the strike price you chose, even though the current price is far less. So for us, it was $23. Now, if Fisker falls down to $22, our put will be assigned to us at $23, which means we have paid $1 more for something that was actually only worth $22. But let's not forget we received the premium. So subtract the premium minus the commission, and you didn't pay over too much, hopefully, depending upon how many you had contracts you had purchased. Now this scenario would be different if we had just placed a limit order. So what I realized off the bat is put option is very similar to just a regular stock limit order. So if you come over here to Fisker and you do order type and do a limit order, you pretty much put here, hey, Allie, hey, over here. So I don't want to pay $24.89 for Fisker. So I'm just going to put $23 right here. Okay. So I'm going to let this stay open maybe for the day, or you can choose good to close. And then you would just place the order. So then it would just sit there if it's good to close until the price for Fisker falls down to $23. And then you could have had purchased it. But in this scenario where the price fell past $23 to 22, yes, it would have had executed and then you would have been at a loss of $1. But with the put option, you received that premium. So you already had a little bit of cash on the side from actually putting in that put option. And that can help you cover some of the loss due to the stock falling. But with all stock, hopefully the one you chose would bounce forward to be going back up quicker than it actually did to stay down. Now, the last option, which could happen, but it's really far-fetched, is the worst case scenario. The stock pulls the rug from under us and it tanks. You know, you accept the shares and hope the market bounce forward. You know, you can close your position before expiration as well. This could be costly, as I mentioned before. The lower the price goes, the higher these prices become. So when you try to close out that actual position, you're paying more than what you receive back. And this is essentially what it boils down to when doing a cash secured put. So summing it all up, and tips to cover your booty. You know, selling cash secured puts is a substitute for placing a limit order on the stock you wish to own. If the stock doesn't go below the strike price by expiration, the put will probably not be assigned to you and you won't own the stock at the strike price. However, the option will expire worthless and you'll get to keep the premium. So that's money in the bank, literally. Just remember, only sell puts on the number of shares you can reasonably afford to buy. Just consider, if it's available, a stop loss plan so that in case the stock does completely tanks, you are indeed covered in that area. So hope you guys like this video. Leave me a comment if you would like, subscribe, and have a good one.